On January 31st, 2019, Altria reported fourth quarter earnings and full year results for the period ending December 31st, 2018. This video provides an update on the company's dividend safety using its most recent operating results. To begin, let's talk about Altria's business model. Altria is a cigarette company that sells the Marlboro brand of cigarettes in the United States, as well as a number of non-smokable brands, including Skoal, Copenhagen, and the Saint Michel brand of wine. The company also has a 10% ownership stake in global beer giant Anheuser-Busch InBev and a 45% equity stake in Canadian marijuana producer Cronos Group. Altria trades on the New York Stock Exchange with a market capitalization above $107 billion. Altria is one of the world's most popular high-yield dividend growth stocks. The company's current dividend yield is nearly 5.6%. Moreover, Altria is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 49 consecutive years. This would normally qualify Altria to be a member of the Dividend Aristocrats Index, a group of exclusive dividend stocks with 25-plus years of consecutive dividend increases. However, the company is actually excluded from the list because of a number of spin-offs completed over the years. Looking ahead, investors interested in owning Altria's shares will likely be interested in the safety of the company's dividend payment. For the remainder of this video, we will discuss Altria's dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. And 4. Its dividend safety in the context of its current debt load. First, let's discuss Altria's dividend safety in the context of the company's current earnings. In the fourth quarter of fiscal 2018, Altria generated adjusted earnings per share of 95 cents, which compared quite favorably to the 91 cents of adjusted earnings per share in the same period a year ago. For context, Altria currently pays a quarterly dividend of 80 cents per share, which implies a payout ratio of 84% in the most recent quarter. Looking out over a longer time horizon, the company's payout ratio is actually lower. Altria generated $3.99 of adjusted earnings per share in fiscal 2018. The company distributed $3 of common share dividends during the same time period for a dividend payout ratio of 75% in the full fiscal year. While this payout ratio is fairly elevated, Altria's dividend appears to be safe for the foreseeable future when compared against the company's current earnings. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Altria's current dividend payment to its free cash flow. Altria generated $1.83 billion of cash flow from operating activities in the fourth quarter of fiscal 2018 and spent $106 million on capital expenditures during the same time period for free cash flow of $1.72 billion. The company distributed $1.5 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 88%. Looking out over a longer time horizon, the company's payout ratio is much lower. Altria generated $8.39 billion of cash flow from operating activities in fiscal 2018 and spent $238 million on capital expenditures for free cash flow of $8.15 billion. The company distributed $5.4 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 66%. Using free cash flow, our conclusion of Altria's dividend safety is the same as when we used earnings. The company's dividend is currently well covered by free cash flow, and we see no risk of a dividend cut in the near future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Altria's current dividend safety in the context of the company's historical recession performance. We believe the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Altria's performance during this time period is shown here. Altria completed its spin-off of Philip Morris in 2008, which accounts for the drastic reduction in adjusted earnings per share that year. The company produced a 6% increase in adjusted earnings per share from 2008 to 2009. In fact, except for a decline in 2011, Altria has seen adjusted earnings per share increase every year since 2008. More importantly, the company's earnings still covered its dividend payment, and Altria continued its multi-decade streak of dividend increases. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. The last angle we will use to assess Altria's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest would have to increase before its free cash flow would no longer cover its dividend payment. At the end of fiscal 2018, Altria had $13 billion of total debt outstanding. The company generated $191 million in interest expense in the most recent quarter, for a weighted average interest rate of 5.9%. The following image shows how changes to Altria's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Altria's weighted average interest rate would need to rise to nearly the 34% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on Altria's dividend safety moving forward. Thank you for watching today's video, which performed a deep dive on Altria's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.